Ladies and gentlemen, Asian guy here. I want you to do one thing right now. Look at the number on your screen. Stare at it until it's burned into your mind. $7,957. That's the high of the day. Think back to Christmas Day. While you were sitting down to dinner with your family, I turned on this camera. I interrupted your holiday because the data was screaming at me. I warned you about Ghost Week. I explained how low liquidity between Christmas and New Year creates a vacuum where price discovery doesn't happen in cents. It happens in dollars. I told you the moves would be violent, vertical, and that banks would be asleep at the wheel. That was 2 days ago, December 25th, and now, December 27th. What just happened? We didn't just drift higher. We didn't have a polite little rally. We exploded. From $71, we shot through $75, $76, $77, and kissed $7,957. An $8 candle in a single trading session. If you're still on the sidelines, skeptical, calling it a bublio, missing the clearest signal in financial history. This market isn't just moving, it's broken free, the blue sky breakout I talked about. It's no longer theory, it's reality. When an asset shatters its all-time high, like we did at $75 yesterday, there is no resistance. No overhead supply. No frustrated investors trying to claw back losses. Everyone is already in profit. And when supply is gone, the price doesn't climb stairs. It takes the elevator. We're up nearly 6% in one day. 169% year. Silver is officially the best performing asset on the planet, beating Bitcoin, Nvidia, and even the S&P 500. And yet, turn on CNBC right now. Are they talking about this? No. They're fixated on retail sales numbers that barely matter. This silence is your edge. We're flirting with $80 per ounce. And the world doesn't even know Italiano. We're still in the stealth phase of the mania, but that phase is ending fast. You can't hide $5 daily moves or a chart going vertical. And the players waking up aren't just retail traders like us. The giants are waking up. That brings me to why I'm recording tonight. The price action is exhilarating. Yes. Making money is fun. Yes. But why is this happening so fast? It's not just Ghost Week liquidity creating the environment. Something pulled the trigger. Something made the algorithms bid silver up to $79 in a panic. We identified a specific signal that flashed on institutional dashboards this morning. A signal that hasn't appeared since 2011. This is the bat signal for the world's largest pools of capital. Pension funds, sovereign wealth funds, Ivy League endowments. These players manage trillions, not billions, and they operate on strict mathematical rules, not feelings. Today, the gold-to-silver ratio crashed below 60. Let that sink in. For years, we traded at 80 to 1 or even 90 to 1. The market said gold was king, and silver. Well, silver was an afterthought. But a sub-60 ratio sends one very loud message to asset allocators. Silver is critically undervalued. Gold is at $4,532. Silver at $79. The ratio, 57.3. For a pension fund manager staring at a spreadsheet, this is a screaming arbitrage opportunity. It says, if you want precious metals exposure, which you desperately need due to inflation and global uncertainty, you get far more bang for your buck with silver than gold. So today's move wasn't just retail FOMO. It was the front-running of a massive institutional rotation. The smart money knows. Come Monday, and especially Thursday, January 2nd, when investment committees return, buy orders will automatically trigger to rebalanced portfolios. Picture this. A pension fund holds $5 billion in gold, none in silver. The model says sell $500 million gold, buy $500 million silver. In the gold market, $500 million is a ripple. In silver, it's a tsunami. And that's just one fund. Multiply by 10, or imagine a sovereign wealth fund jumping in. Suddenly, we're looking at $50 billion of capital programmed to hit silver, regardless of price. They cannot fail to execute. This is why $79 feels like a magnet the market is pricing in future demand. Traders awake during Ghost Week are scrambling to accumulate inventory because they know they can sell next week at $85 or $90. They're front-running the inevitable, and that sets up, next week, a dangerous, explosive scenario. When a market has moved this far, this fast, and you introduce massive new buyers colliding with desperate shorts, the result is extreme volatility. We're walking into a minefield. Profitable. Yes, but deadly for the When the adults return to the market, they'll see $79 and must decide, chase it or suppress it. If they chase, we could see $100 in January. If they attack, leverage and paper positions could trigger a flash crash $10 down in 10 minutes, only to recover an hour later. This is the widowmaker zone. Overleveraged retail traders get wiped out before the real move begins. You must be cautious. The price will flicker like a strobe light, but the path of least resistance is higher. Why? Because gold led, silver is now the slingshot. Gold paved the road. Silver is speeding down it at 200 miles per hour. And that's just the paper market. Wait until we look at the physical market. Futures holders aren't taking profits, they're demanding delivery. Records are being set. The system keeping the market orderly for decades is failing in real time. And the signal this morning, it's the gold to silver ratio. After years of 80 to 1 or higher, it collapsed to 57.3. For institutional investors, this is a mandatory trigger. Sell gold, buy silver. The money isn't moved by hunchy sites, moved by rules and algorithms, trillions of dollars in motion. To put it in perspective, even a 0.1% shift of a giant pension fund into silver is $50 billion. The silver market is a thimble compared to that. The price must go vertical to absorb this liquidity. This is the wave I referenced in the title. And it hasn't fully hit yet because it's the weekend. But here's the real story. Monday morning and, especially next Thursday, when the new quarter kicks off, these allocation orders are going to hit the desks, and they're walking into a market that has almost no sellers. Think $79 is the ceiling? Think the US market is the only game. You need to look east. You need to check China, because the divergence is widening, not shrinking. I just got the night session data from the Shanghai Futures Exchange, but it's the truth the Western world ignores. Front month contract, a 2.601. The last price is 19,200 yuan per kilogram. Change column, up 1,177 yuan in a single session. That's a violent move. Let's do the math carefully. Divide 19,200 yuan by 7.005 to convert to USD per kilo, then divide the 32.15 ounces in a kilogram. The result? $84.50, $85 per ounce. So while New York is hyperventilating over $79, Shanghai is already at $85. That's a $5.50 premium. 2 days ago, that premium was $8. New York rallied $5 today, but the premium didn't shrink. Why? Because China kept rallying, too. We're chasing a ghost. Every step we take, China steps higher. We are on an escalator going down while we run up. The physical price is simply unreachable, because the East is bidding relentlessly. This $85 price is proof. The arbitrage is still broken. If markets were functioning normally, banks would buy at $79 in New York, sell at $85 in Shanghai, and close the gap instantly. The fact that a $5.50 spread exists in a liquid market tells you Western vaults are empty. Logistics or banks are too terrified to ship, fearing they'll need it to cover their shorts. So when pension funds fire up their models next week and see a gold to silver ratio at 57.3, they won't just look at the US price, they'll see Shanghai. They'll notice they can buy New York contracts at a discount to the physical market in China. That makes this a no-brainer trade. Buying paper in New York is like buying $1 bills for 90 cents, an effortless edge. And this is where the panic element comes in. Why now? Why are pension funds rushing? Because they're scared. They see Venezuela's blockade, repo market spikes, inflation data, and most importantly, performance anxiety. In the institutional world, missing a rally is career suicide. Silver is up 169% year. If a fund has zero exposure, alarms are going off. Clients are calling, why did we miss this? Debugging we LLC next week isn't just about value, it's a career preservation. They have to buy silver to stay in the game. They must chase the trend. Combine this with a market that's already a liquid in Ghost Week, with a parabolic price at $79 in New York and a physical floor at $85 in Shanghai. Imagine a $50 billion wall of panic-driven capital preparing to hit the open. This is a volatility bomb. Next week could defy logic. $85 Tuesday, a crash to $75 Wednesday, a rip to $90 Friday. The adults are returning, but the room is on fire. And these institutions aren't delicate. A pension fund needing to allocate $500 million doesn't place careful limit orders. They place market on close orders. They sweep whatever liquidity exists. And with record delivery demands, futures holders refusing to settle the market cannot absorb it. The buying will vacuum the price higher. This is the transition from speculative frenzy to institutional accumulation. Speculators drove us to $75 they sell once they profit. Institutions drive us to $100 they hold for decades. Once this metal hits the vaults of pension funds, it's off the market forever. Locked in the strongest hands possible. So the $85 price in Shanghai is your lighthouse. As long as New York trades below that, you're buying at a discount. The gold to silver ratio at 57.3 is your green light. Silver is cheap relative to gold. The setup for next week is historic. Triggers have been pulled. Algorithms are firing. But before we pop the champagne, we must examine the dark side. The wreckage leaving the banking system. Because while pension funds by banks are bleeding out, the repo market spikes aren't footnotes, they're proof of a systemic rupture. Delivery notices are draining inventory. The PDF reports show who's demanding the metal and why. The run on the bank is accelerating. And this is the critical part. The reason I titled this Danger Next Week, not because I am bearish Shanghai at $85 and the collapsing ratio makes me more bullish than ever, but because the transition is going to be violent. We're moving from a low-volume Holodathian market into a high-volume institutional battle royale on January 2nd. And that transition is rarely smooth. It's explosive. You have to understand Ghost Week dynamics. Senior traders are gone. Liquidity providers are gone. Order books are thin. That's why we could gap up $5 today with minimal resistance. It is like driving a Ferrari on an empty highway. Can hit 200 miles per hour with nothing in front of you. But come Monday, and more critically Thursday, the traffic returns. The 80-wheelers are back. The adults are back in the room. Institutional desks in London and New York are powering up their terminals. They left Aspen with silver at $72. They returned to $79, knocking on $80. This creates extreme gut-wrenching volatility. And the banks, they're bleeding. They just tapped the repo facility for $17 billion. They cannot stop the trend, but they can attack the psychology of trend followers. They know retail is leveraged. They know you're looking at $79 and feeling invincible. The danger. The widow-maker wick. Imagine Tuesday or Wednesday morning during the European Open. A bullion bank dumps a massive block of paper shorts into the thin market to trigger a cascade of stop-loss orders. They could try to flush the price from $79 down to $72 in minutes, painting a massive red candle. There go. Make it look like the top is in. Scare the pension funds away. Here's the brutal truth. The banks aren't trying to help, they're trying to shake you out of your position. They want to cover their shorts at a lower price before the real buying begins. If you're sitting with 10x leverage or trading options with money you can't afford to lose, that wick will obliterate your account. 5 minutes before silver rips back to $80, you could be liquidated. This is the tragedy of leverage in a bull market. You can be right on the direction, right on the fundamentals, and still go bankrupt because you couldn't survive the volatility. That's why I'm warning you. Danger next week. Do not get greedy with leverage. The move is vertical enough. You don't need to amplify it. Holding physical metal, unleveraged miners, or a trusted ETF, that's the winning strategy. If the price flashes down $10, the physical holder shrugs. The leveraged trader, they jump out the window. B, the physical holder. But here's the other side of the danger. The banks, they may try to smash the price, but they're trapped. The pension fund wave. We discuss $50 billion of capital waiting to a low twirl. Instantly buy any dip. Smash to $75. Algorithms see it as a discount, step in aggressively, and drive it higher anyway. The banks are in checkmate. If they don't act, silver goes to $100. If they do act, they provide liquidity for the whales, and it still goes to $100. The volatility you see is just the sound of pieces moving across the board before the king falls. Add the January effect, new mandates, portfolio rebalancing, fresh capital inflow. The strategic narrative for 2026 is already forming: commodity, war economy, and you've seen the Venezuela headlines. Money will flood into commodities, and silver, it's the sports car of the sector. Smallest, fastest, most explosive, even without war panic. January rebalancing alone could push silver to $85. Add the short squeeze, empty vaults, and panic buying, and you have a vertical melt-up. Next week will be violent. Price ranges that used to take a year to traverse will whip in a single day. Open at $80, crash to $74, close at $82. You'll need a stomach of steel. Turn off the minute-by-minute charts. Watch the daily, the weekly, the ratio. As long as the gold to silver ratio is diving, The trend is your friend. Banks are running out of ammunition. Repo spikes show they're out of cash, and more importantly, they're out of metal. Paper games can only last so long before physical reality exposes the cracks. And the physical reality, the COMEX, is being drained at a record pace. I have the CME Group delivery report in front of me. To most people, it's a boring PDF. To us, it's a crime scene report. It shows exactly how many contracts are standing for delivery in December. December is normally a non-delivery month at transition. Traders usually roll positions or settle for cash, but not this year. This year, holders said no. I don't want your cash. I don't want to roll to March. I want the bars. Load them on a truck and send them now. The numbers are staggering. 12,776 contracts standing for delivery. Let's translate that. One COMEX silver contract equals 5,000 troy ounces. Multiply 12,776, 5,063,880,000 ounces. Nearly 64 million ounces of silver demanded in a single month. For context, December is usually quiet. Normally, a few hundred contracts, maybe 1,000, stand for delivery. 12,000 is a run on the bank. 64 million ounces is roughly 8% of annual global mine supply demanded from a single exchange in the middle of the holidays. Why? Because holders know what we know. Venezuela blockade, solar shortages, empty Shanghai vaults. Paper promises for March mean nothing if the metal doesn't exist. They're calling the bluff. And now, the terrifying question. Where is the metal coming from? Look at the registered category in COMEX Voltsa. Physical silver officially available for immediate delivery. It's been bleeding dry for months. Massive withdrawals from Asahi, JP Morgan, CNT vaults. The cupboards are bare. Banks do not have 64 million ounces sitting on pallets. They operate on a fractional reserve system, selling 10 ounces of paper for every 1 ounce of metal in the vault. They rely on 99% of people never asking for delivery. But today, the 1% became 10%, and the system is breaking. The PDF shows who's scrambling. Firms like ADM StoneX are issuing notices. Big banks like JP Morgan are stopping notices, meaning they're catching the falling knife. Tomit demand likely. Leasing metal, borrowing from ETFs. Scouting Swiss refineries. They are desperate to find 64 million ounces. Because failing delivery on even one contract is a default. And in COMEX, a default is a singularity. The pricing mechanism collapses. If the exchange says, sorry, here's cash, that's called force majeure. That moment sends silver to infinity, because every other contract holder realizes their paper is worthless. Physical silver will trade at $150, while paper is $80. The paper market dies. That record, 12,776 contracts, is your countdown clock. This isn't retail speculators flipping contracts. These are industrial users, strategic buyers, draining the system. And this report is fresh runtime, 20 hours, 39 minutes, and 58 seconds. On December 26th. This isn't a past event. This is happening right now. While the mainstream media sleeps, the vaults are being emptied. This isn't just the whales hoarding thousands of contracts. Even the micro silver contracts, the small retail positions, are standing for delivery. Ordinary buyers are taking their 1,000 bars home. Every ounce leaving the vault is a floor under the price that no paper manipulation can break. Think about it. If the banks try to push silver down to $75 next week, does demand disappear? No. Industrial buyers see the lower price and double down. Taking 5,000 more contracts, lower prices accelerate the drain. Higher prices are the only way to ration supply. But at $79 in New York, at $84 in Shanghai, the buyers are still snapping it up. The market isn't rationed yet. The industrial ceiling, likely $120 before the buying slows. So when you see $79 on your screen, don't call it a bubble. Think of it as a failed attempt to ration a scarce resource. The market is screaming for metal, and the price mechanism is trying to catch up. The 12,776 delivery notices are proof. The price is still too low, and this physical stress is bleeding directly into the financial system. You cannot separate the two. Banks are hemorrhaging cash as they scramble to source 64 million ounces. They pay premiums. They pay for expeditious shipping. They pay lease rates. Their liquidity dries up. This brings us back to the smoking gun. The banking system itself is starting to crack under the weight of delivery demand. That $17 billion repo injection this morning. Not a coincidence. It's a direct consequence of this delivery report. When a bank has to deliver metal it doesn't own, it must buy Italiano. To buy it, it needs cash. Short futures, margin calls, trying to source physical. Liquidity needed. The silver market has become a black hole for capital, sucking billions per day. The Fed noticed that $17 billion was the Fed trying to refill the pool to keep banks liquid while they scramble for silver. But this is a doom loop. Printing money to help banks buy silver devalues the dollar, which makes silver more expensive, forcing the banks to need even more money to buy the same ounces. And the NG driving that loop. Those 12,776 delivery notices. Every ounce leaving a vault is an ounce sterilized. Gone. Cannot be sold 10 times over. This collapses the leverage of bullion banks. For decades, they relied on fractional paper ownership, pretending one bar belonged to 10 people. But now, the truck drives away, and the music stops. 9 people are left standing without a chair. Looking at the December delivery report, with JP Morgan and others halting notices, it's clear. The system is being drained. This record December delivery is the most bullish fundamental data point of 2025. Forget charts. Forget RSI. Forget sentiment. Demand exceeds supply massively. And until that imbalance is corrected by new supply, which takes a decade, or a price revaluation, which happens overnight, the trend is vertical. Do not be shaken by next week's volatility. When you see dips, remember, 64 million ounces are being extracted from the system. Paper prices are noise. Delivery reports are the signal. The vaults are emptying. And here's where it gets systemic. As banks bleed cash to source metal, stress transmits to the broader financial system. The repo spike was just the first crack. Ask yourself, why would the Fed care about a few billion in silver losses? Why risk the credibility of the dollar to save trading desks? Because we live in a world of daisy-chained leverage. No asset exists in isolation. Silver is not just a commodity. For banks, it's financial collateral, a foundational block in a tower of rehypothecated value. Paper silver isn't just sold, it's leased, swapped, bundled, used to borrow against treasuries, tech stocks, or FX positions. One default, and the contagion spreads. Imagine a major bullion bank call it. Bank X fails a margin call on silver. Default triggers the COMEX clearinghouse to seize Bank X's collateral, treasuries, corporate bonds, cash. Now, Bank X is frozen. Pension funds that rely on swaps with Bank X panic. They sell bonds. The bond market crashes. Bank Y gets margin calls. Domino effect. This isn't 2008 with subprime mortgages. This is a naked short in a strategic metal with a real physical shortage. The Fed injected $17 billion because their monitors showed the red zone. A failure in a commodities division could lock up the repo market. The silver squeeze isn't just hurting shorts, it's threatening the liquidity of the entire US banking system. The choice was stark. Choice A: let the free market function. Banks fail. Shareholders wiped out. Silver price resets to $200 overnight. Chaos, but honest. Choice B: intervene. Print money, provide liquidity, save the banks, destroy the market signal. The Fed chose choice B, as they always do. But now, they're trapped. By injecting $17 billion, they've poured jet fuel on inflation. And the signal to the world, the US dollar, the supposed risk-free asset, just became less reliable. Today, the Fed admitted something the media won't touch. The banking system backing the dollar is so fragile that a $5 move in silver threatens its solvency. They acknowledge they must print money to prevent a deflationary bust. And what happens when you print money? The currency devalues, and when the currency devalues, hard assets go up in price. And when hard assets go up, banks' short positions get worse. Do you see the trap? The very act of saving the banks pushes silver higher. They save them at $77 by printing $17 billion. That printing alone sets the stage for $85 next week. Then they'll print another $2 billion, pushing silver to $95. It's a self-defeating feedback loop. They're trying to put out a fire by smothering it with cash, but cash is flammable. They are trapped in a liquidity vice of their own making. They cannot stop printing, or the system collapses. They cannot keep printing, or the currency collapses, and the market knows it. The smart money, the sovereign wealth funds, the macro allocatas are watching this repo spike with terror. They understand what the Fed just did. For the past 20 years, the Fed put protected stocks. Now, the Fed put is under silver. By bailing out the shorts, they've capped the downside. They have effectively provided infinite liquidity to prevent a blowout. If you own silver, the central bank is subsidizing your risk. If the price drops, the physical shortage takes over. If it rips higher and breaks the banks, The Fed prints causing inflation, which pushes the price even higher. It's heads you win, tails you win. If you are holding physical metal, this is what drove the 50% gains in junior miners today. The equity market is forward look. It prices in the pivot. No press conference. No dot plot update. Just $17 billion wired in the dead of night. And the market pivoted. This is QE, infinity, without a name. And there's a wider implication for the too big to fail concept. The bullion banks that tapped the facility are no longer independent. They are wards of the state, zombie utilities kept alive to facilitate credit flow. Suppressing silver is no longer a private game, it's states. Repeats. Governments trying to peg commodity prices always fail. Pool, 1960s, collapse under a run on gold. Trolls, 1970s, same story. New York silver pool collapse in 2025. The run on silver is draining the COMEX. The mechanism is the same. And the outcome will be the same. A violent, chaotic repricing, where price meets reality and supply finally balances demand. Isn't just financial, it's psychological. Trust is the currency of banking. When banks tap the repo facility, trust evaporates. Demand higher margins. Financial conditions tighten globally. XY crash. Normally, a crisis drives dollars up. The crisis is the dollar itself, a solvency of its issue. Connect the dots. $38 trillion debt, $2 trillion annual interest payments, and the Fed printing to save commodity speculators. Is silver. Silver. You can dilute dollars, euros, even Bitcoin. Element 47, forged in supernovas, finite. It is the antibody to the virus of fiat. Are the cure. The Fed can suppress the fever, but the patient is too sick. The geopolitical angle. Beijing saw the $17 billion repo Moscoso Italiano. They are watching the US bleed. Their strategy. Buying more metal, tightening blockades, squeezing until the US breaks. $1 billion didn't just save banks, it signaled vulnerability to rivals, ensuring escalation in the war on shipping and commodities. Keep silver above $80. Force the Fed to print $50 billion. $80, maybe $100 billion. 101, and the Fed just walked into the trap. Dollar's target isn't about charts or mind ounces anymore. It's a fundamental shift in monetary regime. The buyer of last resort for the bank's bad silver bets. Dollars, but zero silver. Rise to infinity in dollar terms to balance the equation. $1 billion was all in. The Fed pushed its chips to the center, but the market holds the royal flesh, the physical metal. Nothing but a printing press, losing its power to command respect. The beginning of a new monetary epic. Morning, the repo panic, the capitulation of the shorts, record delivery demands confirm one thing. The pivot is here. The mainstream media obsessed over the pivot. When would Jerome Powell cut rates? When would tightening stop? This conference, a polite dot plot adjustment, they expected ceremony. The pivot arrived in the dark. It arrived as a desperate $17 billion liquidity injection, saving a banking system, choking on its own leverage. Is the pivot. The bank is forced to print money to prevent a systemic collapse triggered by a commodity squeeze. The tightening cycle is mathematically over. Inflation and bail out the banks at the same time. The banks, and by choosing the banks, they have surrendered to inflation. Thing for silver. Talking about a simple supply-demand deficit, we are talking about a currency devaluation event. Magical safety net protecting stocks has now been placed firmly under the silver price. Think about that. Tomorrow, the bank's collateral problems might ease temporarily, but the physical shortage remains. Just rebuilds. But if silver rips higher, which it is doing, the banks face insolvency, and the Fed is forced to print values the dollar, which drives silver even higher. Inadvertently created a mechanism where their own survival reflex pushes precious metals to the moon. They are trapped in a room with shrinking walls. They must destroy the currency, and as the currency collapses, the nominal price of real things must rise potentially to infinity. $100 price target is no longer speculation. It's policy, certainty. Outputs of the Fed's actions. And hundreds of billions or eventually trillions to keep the repo market and derivatives alive. Silver at $100 is actually cheap. Inflationary liquidity cycle. $100 is the new $20. The next few weeks. Extreme volatility. The beast is wounded, but not dead. Armed with $17 billion in Fed liquidity, may attempt one last desperate smash. Short the market Monday morning to scare retail investors. Do not panic. A flash crash of $10. Smile, that's just making physical metal cheaper for China, India, and savvy holders. In a shortage don't create supply, they accelerate panic. In futures and spot prices reveals the truth. Inasorta spot trades higher than charging $10, $15, $20 over spot. That is the real price. The screen price is a lie. Follow the truth. In Obtanium phase, we are approaching the moment when major dealers run out of stock. The 12,776 delivery notices are draining the wholesale market. Are empty, retail shelves go bare. Disappear. Become infinite for those who aren't holding. Foreign coins stretching to February are early signs. Sitting on cash, waiting for a dip. Russian roulette with a loaded gun. Overpaying, it's not being able to buy at all. The greatest wealth transfer in history. Wealth isn't distributed, it's transferred. Paper, bonds, currencies, and derivatives to holders of real assets. The financial economy cannibalized the real economy. Now, the tide has turned. Stackers and physical holders, you are the new captains of capital. Banks are insolvent. The Fed is trapped. Vaults are empty. The stars have aligned once in a century. Fiat currency that is being printed to save your enemies all the line. $100? Do not sell $4. Borrow against it. Trade for land. Trade for a business. Back into the burning fiat system. $1 billion signal this morning was the flare gun. It lit up the battlefield. The banking system in full retreat, abandoning the fortress of sound money, burning the furniture to stay warm. You have the position. You have the patience. Yes, but for the first time, it is rigged in your favor. Guaranteed your upside by guaranteeing the inflation needed to save the banks. The reality is beginning. This wave is unstoppable, and you are riding it. From Financial Historian Chill Edition. Site valuable? Like, subscribe, and share. Stay patient and prepare for the inevitable.